Okay, good. So yeah, we usually do it on Echo 360, but because of this snow forecast, I decided to stay home. And I hope it's fine with everyone. And I'm really sorry for cohort B. Those are supposed to be on campus, but we will balance it. So no worry, we will be fine. And we will have 3 more students. Let's see how everyone will show up. Hi, Brian. Thanks for turning on your camera. It's good to see everyone's face. I saw Elisa, and it'd be great if you feel comfortable to turn on your camera. If not, that's fine. Okay, great. So what we're gonna do today, we will again recap last chapter's learning. Last chapter we started chapter 2. We were kind of halfway of chapter 2. So we will record that one. We will recap that one. And then we will finish our rest of chapter 2. And I have few problems that we will solve together. That's the deal. And at any point, if you have any question, or if you don't understand anything, please stop me and ask me questions. Although you are not in class, pretend we are very connected. And don't hesitate to turn on your microphone and ask me questions, because sometimes if I start giving lectures, I may not see your chat instantly. Okay, good. So now let's recap what we actually learned last class. So last class we started with consolidation. And for consolidation, we all know that your ownership will be 50% or more than 50%. And here, the consolidation scenario or the acquisition could be into 2 ways. One is dissolution occurs, another is no dissolution. So we focused on those big journal entry last class when dissolution occurs. So dissolution occurs means that the target company or the acquired company's entity will be dissolved. So why don't we take some note? So I would suggest everyone, if you have your notebook, please make a quick summary, and I'll write here, and you can also take some notes here, and that will kind of give you some idea what we're gonna do today. So here again, I will just recap what we learned last class. We started with consolidation. And for this consolidation, we all know there could be 2 scenarios. Of course, you have to acquire 50% or more than 50% of other companies' stocks. But remember, the scenario could be dissolution occurs. So one is, yes, there is a dissolution. That means the acquired company's entity is gone. And we also gave you some hints that I love to call it one-shot game, because on the day of the acquisition, the acquirer company or the parent company will take all of the target company's assets and liabilities from their book to the parent company's book. And then the parent company's book or all of their accounts will be closed. One-shot game means on the day of the acquisition, you have to do one big journal entry. So this is dissolution occurs, and we saw that example last class. We didn't finish it, but we will continue that one. Then another situation, you will see there is no dissolution. So no dissolution means that the acquired company will maintain their own book. Although they may not stay at a separate public company, and someone asked one question, probably Sephora last class, that how could we know their information? So that acquired or the target company's financial statement may not be public, but they will maintain their own income statement, balance sheet, because their books are not closed. That means there is no dissolution. Both entities are maintained. So legally, there will be a separate company. They will maintain their books and accounts. So both entities are maintained. But now what will happen at the end of the year? The parent company will prepare a consolidated worksheet. And that what we'll see, big worksheet, we'll see on slides. I'll also have Excel example, and we will practice some quick problems. So the parent company will prepare one big worksheet. It's called consolidated worksheet. Consolidated worksheet. And here we will also learn some journal entries. Those are known as consolidation entries, because those entries will help you to do some adjustments to eliminate some double counting. Of course, consolidation or consolidated worksheet means kind of you are adding two sets of financial statement, and we got some idea last class that the target company will close their income statement items, which means their revenues and expenses, and their net income will be adjusted with their retained earnings, and retained earning is also reflected in your balance sheet. So basically, consolidation, or if I mean you have to add two parties' financial statement, we will call it parent and sub. So two parties financial statement, this addition means we're gonna add balance sheet to balance sheet. But again, for this balance sheet part, subsidiaries items that we will be adding is basically their assets and liabilities. And remember, whenever you will do any consolidation entry, no matter dissolution is occurring, you are writing or entering one big journal entry, or at the end of the year, you are preparing the consolidated worksheet. Every time when you're gonna consider your subsidiaries, assets and liabilities, we will record everything as per the fair value. So subs fair value. So you will see some problem. They will show both like subsidiaries book value column and fair value column. But remember, when we're gonna do this consolidation, we will take everything as per their fair value. And then last chapter, we got some idea about goodwill, but this chapter, we will see real numbers and we will see how to calculate goodwill. Last chapter, we didn't have any goodwill. Still, I showed you the structure, how to calculate it. We will follow that structure and we will see a quicker way, an easier way to calculate goodwill. So this is kind of the recap what we did last class, and we will start from here. The dissolution occurs and how we're gonna do the big journal entry. And if you remember here, we also discussed there might be three types of situation. Of course, when the parent company is going to buy the subsidiary company, they have to offer a purchase price, right? Now, you have to compare the purchase price, that means the price the parent wants to pay to acquire the company, versus the net fair value of your subsidiary company. Sometime you will see that the purchase price is equal to their net fair value, which is very coincident, but theoretically it can happen. Most of the time, I would say almost 100% in real world example, you will see purchase price is higher than the subsidiary or the acquired company's net fair value. This is real world example. Always you have to pay higher than their fair value. Otherwise, no one will be interested to be sold. And some scenario the textbook mentioned in real world, which is rare, that purchase price is less than the net fair value. Now, here, if our purchase price is higher than the net fair value, what do we call the difference? Anyone want to use the chat box? If purchase price is higher than the net fair value. Yes? Okay. I actually cannot see that. Yes, great. Yeah, now I can see the chat box. Of course, it's known as goodwill. Excellent. And most of the problems you will see like this. Now, since the textbook mentioned it, that there might be a scenario, purchase price is less than the net fair value, which is really weird in real world, but this could be one example. Now, this scenario or the difference, what we're gonna call? We discussed a little bit last class if you check your notebook. If not, I can help you. So try to think of an acquire perspective. I'm trying to buy something, but I am giving a price. I'm offering or paying a price which is less than their fair value. That means, yes, Jasmine, that means I want something, right? I made some gain. How did I make the gain? Through some bargain. Fiona, excellent. So we call it this situation bargain purchase, or you are making a gain on bargain purchase. So you might have few like multiple choice question, no calculation, just concept. So I'm glad that you remembered those. So here again, this is just last class recap. Now let's start where we were here. Now I'm going to share my slides and you will tell me if you can see it. So here we started our consolidation. We need to go back and forth, but I hope we will be able to make it. So everyone can see the slides? Yes, no? Okay, great. So here, I'm very happy that you all are engaged using the chat box. I'm not feeling lonely. Yes, great. So here, actually we did this one. And I told you that consolidation means two parties' financial statement. You are bringing together, adding together. But remember the concept, it means like you are adding balance sheet to balance sheet. And for the balance sheet item, subsidiaries items, we're going to mean only their assets and liabilities. And every time we're going to record as per their fair value. Don't be confused with the book value. Book value actually doesn't make any sense. We learned that book values are usually understated. So now here we will see dissolution occurs, and I discussed last class how we can calculate the fair value. There are several ways. You can read the slides, or if you could read the textbook, that would be great. Now let's start from here. So everyone, please pay your attention. Someone left the meeting. I can see it from here. Please do not leave the meeting. Okay, AJ, you are back. Thank you. You might have some internet issue. So please make sure you learn everything in class and later you don't need to spend time. So this is the number. Please pay your attention. Thank you for joining the meeting again. So here, BigNet is the parent company. And small port is the target company. Before the acquisition occur, we will call them a target. Now look at the numbers. Small port's book value is 600,000. Fair value is 2.55 million. That can happen, especially a company like this. They say they are business software company, internet company, those type of IT or information technology based companies. They don't have much physical assets, but they have all those like software or other technologies, and sometimes they might have some copyrights, R&Ds, and those we actually cannot capture using our traditional accounting. And that's why you will see those type of companies' book value is very, very below than their fair value. So just look at the number. Book value is only 600,000. Fair value is 2.55 million. Now the deal is that BigNet is going to purchase small port, And first scenario, big net paid exactly equal to their fair value. That means 2.55 million. So now this is for every problem you will be given this type of table. So try to understand. This is called one column presentation. That means credit items are within a bracket. You see here, these are not negative numbers, notes payable. They put it in a parenthesis or bracket because these are credit items. So when you're going to do the consolidated worksheet, don't be confused. Those are credit items, and that's why we put it within bracket. Now, big net column is the parent company's number. Look at the small ports column. So for small ports, you are given the book values, also the fair values. Remember, when you're going to record or do the consolidation entry, we will focus on the fair value. So I would suggest if you have your own slides, you can download and open that, because I might ask you a question. We may need to go back and forth. So now here my first question, how the journal entry will look like. Remember, dissolution occurs, one big journal entry. So now look at that. What BigNet is paying to buy a small port? BigNet is paying $550,000 cash, plus BigNet is giving 20,000 shares. So the total purchase price is how much? We have to look at the price of this share, but don't be confused. BigNet's shares par value or the face value is only $10, but currently their shares are selling at $100. So when I will ask you what is BigNet's total value of those shares that they gave to a small port, you have to consider this $100. That means what is the total purchase price? Total purchase price is this $550,000 cash plus 20,000 multiplied by $100, that means 2 million. That means if you add that, which is 2.55 million, which is exactly their fair value. That means whatever they are purchasing, they are giving the same. Now, how you can record it? So remember, this is one short game, one big journal entry, and the objective of this journal entry is to transfer the acquired company's assets and liabilities from their book to your book. You means you, the parent. So these are all small ports or the acquired company's assets and liabilities. So you are taking all those and you are recording it on your own book. Remember, what numbers are those? Are those their book value or fair value? Chat box, quick. So when you are recording your subsidiaries, assets and liabilities, are you recording them as per their fair value or book value? Sheila, these are actually fair value. I'm glad that you answered the question, but if you go back, look at that. If you go back here, if you see small ports values, let's see. Let me take one example. This one. Look here. Capitalized software book value is only 100,000, but fair value is 1.2 million. Because you know, software sometimes you really cannot predict the actual value, and when you record on your book, you may not record it as per the actual value, because the software, if it's a great software, everyone is using, the prospects or future value is high, the fair value can be changed. So that's why this capitalized software, you see huge difference between the book and fair, but we're gonna record everything, Sheila and everyone, as per their fair value. So look at those numbers. When we did this journal entries, we recorded everything as per their fair value. I'm sure you will never forget it. Sheila will never forget it. We will record everything as per their fair value. Now the credit part is what? Credit part is what you paid. You means BigNet. You are the parent. So you paid cash. Cash is gone. You credited cash. You issued stocks. So you know when you issue a stock, of course, you have two components. One component is $10 PAR par value. Another component, you know this term, additional paid in capital. So the PAR par value portion we credit it as common stock, and the additional paid in capital we also credit it, and you should know how to calculate it. Their trading price or current selling price is $100 and PAR par value is $10. So $90 is their each share's additional paid in capital. So total number of shares 20,000 multiplied by $90, which is each share's additional paid in capital. This is how you get this additional paid in capital number. Please make sure you know how do I get all these numbers. Last class, someone mentioned we can subtract all these. This is our total debit. Subtract all the items. You can plug in your additional paid in capital. That's a smart idea. But theoretically, if you want to know how to calculate additional paid in capital, the difference, $90 per share multiplied by 20,000. So here, this example is great. Whatever they are acquiring, they are paying the same. Their net fair value is 2.55 million. They are paying in total, cash plus shares, 2.55 million. So we are good. How about this example? Can everyone please take your calculator and tell me what is the purchase price? Here, the same example, BigNet is purchasing a small port. BigNet paid 1 million cash plus BigNet issued 20,000 shares. So what is the purchase price? Both together. 1 million cash plus shares. Come on. Yes, Alisa, you are right. Your total purchase price, Matt, you are right, 3 million. So now here you see that whatever you are acquiring, as per their fair value, it's 2.55 million. And Chris, you are right too. But their purchase price is now 3 million. I hope everyone know how to calculate the purchase price. This is their cash, 1 million, plus stocks, 20,000 shares multiplied by this $100, which is their current price, share price. So total purchase price, or sometime you will see the term they use consideration. Total consideration is 3 million. So purchase price and consideration, both are same synonyms. So now you know their fair value is 2.55, but they are paying 3 million. And the difference, you already know that. The difference, we call it goodwill. Now, how it will look like on your big journal entry? This is a separate scenario, right? What if their purchase price is 3 million? Then BigNet will record it this way. So first, they acquired everything, assets, all of these assets, notes payable, liabilities, everything we recorded as per the fair value. Now, if you show what you paid, we paid cash, so we credited cash, we issued shares, so we did this part, but total portion or the credit side is higher than the debit side because you are paying more. So the difference, we call it goodwill. And goodwill, of course, is an asset. It's kind of an artificially created asset based on your purchase price. So since it's an asset, we debit it. Or in the other way, if you want to balance the journal entry, you need to plug in the numbers on the debit side. We will call it goodwill. So this is the journal entry. Of course, we'll practice some problems, especially in chapter 3, how you can do the journal entry. Because for your exam, I will have some open-ended questions. That means I give you a box. You need to type or write down the journal entry. Some the connect problems will be from drop-down menu. Some you need to write by hand. I mean, you need to type in the journal entry in a box. So please make sure you know the journal entry. If you know the journal entry better, the concepts will be stronger in you. Now, Scenario number 3. So I told you that this may not be in real world example, but this can also happen. So here the purchase price is less than the fair value. What they are paying? BigNet didn't give any cash. They just issued some shares. So how many shares they issued? 20,000, and per share price, selling price is $100. So their purchase price is how much? The purchase price. Let's use the chat box. If you look at these 3 lines on top of the box, what is the purchase price? Let's see if anyone can calculate the purchase price. There is no cash, only shares. What is the purchase price here? Of course, they are paying something. Yes, Alisa, the purchase price. Matt, Brian, everyone, please participate. Jaden, excellent. Sephora, the purchase price is 2 million. So that means whatever they are acquiring, the net fair value is 2.55 million, but their purchase price is less than that. That means they are making a gain on this acquisition. Yes, Jeff, thanks for showing it. So, you know what? Gain is always a credit item. So we will show the gain on our credit side. Or if you want to make it a plug-in thing, you can do that. Because first you have to show what you acquired. You acquired all these assets and liabilities. So we recorded all these as per their fair value. Then you record what you paid. You issued stocks. So here we credited stocks additional paid in capital. Now if I ask you to check the journal entry, you will see the credit side is off by 550,000. This is another way to plug in the credit side is off. So we will plug in as gain on bargain purchase. So these 3 journal entries just you need to know for dissolution examples. Dissolution is simple. 1 big journal entry, 1 short gain. So you might have some questions. There might be goodwill is very common, or there might be the scenario like this. You have to record gain on bargain purchase. Now here we will see few more information, and we'll see the big worksheet or consolidated financial statement. So sometimes you will see you have some costs related to that consolidation process. For example, you may need to hire an attorney, or some investment bankers may help you to assess the fair value of that target company. Right, so those are kind of your immediate expense. Right, so now here, how we gonna record all those? Right, so this type of acquisition cost is not part of the fair value you received. Those are your immediate expense. But if you issue some stocks to pay the price, and if there is any cost to register or issue stocks, that will reduce their fair value. So now we will see examples and it will make more sense. Now we are doing the consolidated worksheet. First, please keep your patience because I will go over a few slides before we practice the problems. And when I just talk and talk, that may feel really bored. You may not be engaged. So time to time, I'll ask question and ask you to use the chat box. It's not only few people, Elisa or Brian or Fiona, it's everyone. Please use the chat box when I ask questions, everyone, otherwise you feel bored. So now here, we are doing the consolidation process. We will prepare the consolidated financial statements, and we all know that consolidated financial statement or that big worksheet you have to prepare when there is no dissolution. That means when separate entities are maintained. That means the sub will maintain their own books and the parent company will add 2 financial statements at the end of the year. This is kind of just an extra paperwork. So combining or adding two financial statement means you are just adding balance sheet plus balance sheet. And for subs balance sheet, we means their assets and liabilities, and of course everything we will do at par fair value. So now how we will do it? So you will see several steps here. Initially, I'm repeating, initially the parent company will show this acquisition as an investment, just like you did it in fair value and equity method in chapter 1. So this is actually an investment, right? And then what we will do? Later, we will eliminate the investment balance. Rather, we will add balance sheet to balance sheet. So I'm repeating, initially we will show it as an investment, right? When you are purchasing another company, of course, it's an investment, but we will reduce the investment, we'll make it 0, and we'll add balance sheet to balance sheet. So I'll give you one example. Like few years ago, we acquired the GE headquarters, which is now our beautiful West Campus. So when we acquired it, we paid, for example, $26 million. Sacred Heart paid $26 million to acquire GE headquarters. So now Sacred Heart could do two ways to show it. So they could show it like this: investment in GE headquarters debit and cash, or whatever. If they issued bond, I heard they issued bonds payable, credit, right? So one way is to show this big purchase as an investment. So investment will be debit. Another way is to check what's the total assets, or if there is any liabilities in this West Campus, then check all those assets and liabilities and record those. And they figure out, well, we do have two buildings, East building, West building. We have a guest house, a helipad. We have all these furnitures. We have all these beautiful artworks, these acres of land. So if we count all those assets, or if there is any mortgage or liabilities, then another way to show these West Campus purchase as just showing all the assets and liabilities as per the fair value. And then if you pay cash or bond, you can credit those. Now remember, there are two ways Sacred Heart could show these West Campus purchase. Either they could show it the total amount as an investment, debit thing, or they could show all those assets, debit, or if there is any liability. So you could do either or the other method. You cannot do both. So the idea is here, we can show it just as an investment, but our goal is to add balance sheet to balance sheet. Our goal is at the end, we will show all of their assets, liabilities as per fair value, and we'll add to our asset liabilities. So we have to reduce this investment item. That's why we will start with an investment, and gradually we will make the investment balance 0. And at the end, we will just add all of our asset liabilities plus their asset liabilities. In a simple word, this is the consolidation process. Now we will see different steps. You don't need to memorize all this because I'll show you the example in a minute. But try to understand every step and how it's affecting on that worksheet. So first, what they will do, they will show it as an investment, just like the equity method. And then we will prepare two columns, one for parent company, another is for subsidiary company. Then we will remove subsidiaries equity, stockholders equity. Remember, the idea is to add balance sheet plus balance sheet, but for balance sheet, it's only assets and liabilities. So we don't need to show stockholders equity. So we will remove subsidiaries stockholders equity. And I told you initially we will start as an investment, but we cannot show both. Sacred Heart could not show both investment in West Campus, 35 million as an asset, plus all those assets, they cannot show both. So we have to remove the investment part, and then rather we will show subsidiaries, assets, liabilities, and we will add those to our items. Then at the end, once we eliminate the investment and add our balance sheet, their balance sheet means only assets and liabilities, then we'll find the final column, which is known as the consolidated column. And remember, here we will also figure out our consolidated net income, consolidated retained earnings, and of course consolidated assets and liabilities. But I'll show you, for asset liabilities you need to add across the columns, and for net income we will just do the vertical computation, right? That means revenues minus expenses. Now let's see the same example. Big nets, this is the parent's item, and then a small port, this is subsidiaries book value. So if you look at their balance sheet or income statement, you will find all this. Remember, book value means whatever is on their book, right? So let me ask you a question. If I ask you, what is the net book value of a company? How could you calculate the net book value? Everyone, are you here? Net book value. Net book value. Let's see who can remember. I asked it in first class and last class too, and I say don't forget it. What do you mean by net book value? Oh yes, yes. Let me check. Someone mentioned, yes, it's asset minus liability, not asset plus liability, right? Yes, yes, Alexa. Net book value, Anthony. Great, Alex. Okay, Melissa, asset minus liabilities. That's net book value. Very good. Please, please do not forget it. And here you have little more information. This is their purchase price. They didn't give any cash. They just issued stocks, and they have some contingent liabilities. Sorry, it should be contingent liability. So here, contingent liabilities means that sometimes you might have some condition with your subsidiary that, okay, if you could come up with certain number of income next year, we will pay you more. So that means this contingent liability is not paid on spot, but you're gonna pay it in future. So that's why if I ask you what is the purchase price, it should be both together. So the purchase price from this deal is, of course, the value of these stocks, which is 2.6 million, plus these contingent liabilities. Remember, contingent liability is part of the purchase price or consideration. You are not paying it on spot, but there might be some condition. Okay, hey, subsidiary, if you could make your earning per share, or if you could meet this forecast, then I will pay you this much amount in future. And then you could know what is the present value, and this is kind of a conditional payment, and you have to include it when you calculate the purchase price. And then they have some other expenses, and these are for attorney fees. So it's not the stock related expense. So now I told you that initially you will just show it as an investment. So what the parent company or big net will do, they will debit investment in a small port. This is their total purchase price, 2.620, both together, and they will credit what they are paying. They're not paying any cash, it's fine. They issued stocks, 26,000 shares, $10 per share. You know, you have to credit this. And you should know how to calculate the additional paid-in capital. And then here you also have contingent liability. So all these together is your purchase price. Then you have some other expense. This is probably attorney fees or investment bankers fees that you have to spend it on spot. So you debit expense, or you can write it down acquisition expense, credit cash. Someone left the meeting. I can see it. Please pay your attention. And my next question, how did I calculate this additional paid-in capital? So please use the chat box, and someone broke it down, write down. Yes, Fiona, excellent. Everyone got it. Fiona mentioned it. My question was, how could I calculate this additional paid-in capital? Do not look at Fiona's numbers. Do it by yourself or Alexa's. Yes, additional paid-in capital, $100 is their current share price, $10 is PR par value, $90 each share, additional paid-in capital. And how many shares you issued? 26,000. So 26,000 shares multiplied by 90. I hope everyone know how to do the additional paid-in capital. So what we're gonna do, first we'll show it as an investment, and then what we pay. This is just like the journal entry you did in chapter 1, first time investment. And then of course we have some expense. Now let's do the steps. You saw those boring steps, but if you see the numbers, you will feel better now. So what we're gonna do, first, we will record all the numbers in one column, parents numbers. This is parent company. And then in another column, we will plug in subsidiaries number. Remember, first when we're gonna plug in, we will plug in as all their book value, because we are just presenting two parties' financial statement on a worksheet. And this is called one column presentation. I'm repeating, we are presenting two parties, parent and subs, financial statement. Of course, when I mean financial statement, this is their books, right? So that means here, if I ask you to do the first two columns, and sub already closed their revenues and expense, so you don't need to worry about subsidiaries, income statement, or statement of retained earnings. This is how it looks like. So it's really hard, but please pay your attention. I may ask you some questions here. So I'm repeating, I'm doing step 1 and 2. Step 1, this is, you see the parent company's financial numbers. So I'm making one column financial statements. So here I have this income statement, and you already know how to prepare income statement. Revenues and expense. This is how you get net income. But the tricky part here is that credit items are within bracket. And I have an Excel assignment. I made a video because previously I used to do it in class, and it takes so much time because different students are at different pace with Excel. So if I do it by hand and try to address each student, it takes the entire class. So what I did the same thing on Excel on an Excel sheet, and I showed how to calculate goodwill or this type of little bit of formula on Excel. I know some of you are expert, especially if you double major in finance or you took the Excel course. But what I'm gonna do, I will post the video, you will watch it, and you will solve one worksheet for your practice. So now just try to understand the concept, and then of course we'll do by hand, and you have additional practice on Excel. So here I said this is one column presentation. So I put all those numbers from here, big nets numbers. Everyone, please pay your attention. I have a short question now. And if you cannot see it well from this WebEx screen, you can check your own slides or textbook. I just scanned it from the textbook. I just took screenshots from my e-textbook. Everything is exactly in the textbook. So look at this number, big net. It's a little bit tiny. Look at big net's revenues. You see here my cursor. I hope you can locate it or point it out. Big net's revenue is 1 million. So we plug in the revenue. It's a credit item. That's why it's in bracket. Big net's expense is 800,000. Wait a minute. It shows 840. Why? Because these numbers are right before the consolidation. Now, on the day of the consolidation or acquisition, you did these 2 journal entries, right? Because initially we are showing it as an investment. So on the day of the acquisition, we did these 2 journal entries. And then right after that, we are preparing these worksheets. So these worksheets will reflect the numbers right before the acquisition plus these 2 journal entries. I'm repeating, everyone, please try to understand. These numbers are given right before the acquisition. Now, on the day of the acquisition, you showed this purchase as an investment and you recorded these journal entries. So now, right after the acquisition, you are preparing this worksheet. So these numbers should reflect the basic table before acquisition plus these 2 journal entries. And that's why, if you look at everyone, please look at that. Before acquisition, the parents' expense was 800,000. Now, on the day of the acquisition, they paid some attorney fees or acquisition-related expense, 40,000. So right after the acquisition, when we are plugging in everything on this big worksheet, we are taking both this pre-acquisition information plus on the day of the acquisition, and that's why your expense is 840. So please make sure you do these adjustments. 840. This is before acquisition plus this expense. And that's why you will see the textbook or the slides, they put some asterisks here, this little star mark. That means those accounts are affected by these acquisition day journal entry. So we did parents' income statement. We did a statement of retained earnings. Beginning balance, you will figure it out. Beginning balance 870. Net income, we brought it from here. Dividend paid, all information is given, parent column. So we are just plugging in the numbers from this given table before acquisition. At the same time, we adjusted these 2 journal entries, and then we showed our latest numbers in the first column. And one thing, investment. You didn't see any investment before acquisition, but you debited investment. So we will also write this investment in a small quote, and you already know that this investment is your total purchase price. And then the rest, assets are pretty simple. You take all these assets from their book. This is nothing, this is their book. Financial statement. You put all the liabilities. It's given here in the first column. Now, you have this contingent liability, which is created because of the acquisition. It's a credit item, so you plug in this contingent liabilities. Now, you need to adjust common stock and additional paid in capital. I am repeating and I am emphasizing on this part because this is a common mistake. So when students do the worksheet, they sometimes forgot about these 2 journal entries. They just take the numbers from the problem and plug in here. But you have to adjust these 2 journal entries. Don't forget these acquisition day journal entries. Now, my question, it's a hard question. Let's see who can answer. Everyone, not only 2 or 3 people. I hope everyone is here. You all are here. My next question, how could I figure out the common stock? 1.86 million. I'm talking about the parents' common stock right after the acquisition. If you look at the parent column, what is their common stock here? But it's showing common stock 1.86. Anyone here who got it? My question is, everyone, please look at the numbers and then tell me how could I get this common stock 1.86 million. This common stock is parents' common stock right after the acquisition. Yes, you are absolutely right. We add this new common stock to their old common stock. Excellent. Who is that? Sorry, I didn't notice your name, but it's great. So whomever caught it, everyone get it, please. So my question is, how do I get this common stock number? So this common stock, or whatever I'm putting it in the column, is their number before acquisition plus whatever you did on the day of the acquisition. So my question is, how could I get this common stock, big net common stock 1.86 million? So look at their common stock before acquisition. This is common stock before acquisition 1.6 million plus they issued new shares and you already credited the common stock thing. It's 260. So you have to add that. Excellent. This is, you will find their common stock right after the acquisition. Now my next question, how could I get this additional paid in capital? Conceptually, it's the same. How could I get this additional paid in capital? 2.38. It's the same. Look at what is their additional paid in capital before acquisition. Their additional paid in capital before acquisition is 40,000. Then they issued new shares, and because of that new shares, their new additional paid in capital is 2.34 million. So you add both pre-acquisition additional paid in capital plus new additional paid in capital. This is how you got the parent's company's updated additional paid in capital. So you might have like this short type of multiple choice question. We'll practice those, but try to understand the concept. So far what we did, we plug in all parents' numbers, but do not forget when you plug in the numbers, it should reflect both pre-acquisition plus these 2 journal entries you recorded on the day of the acquisition. And then we plug in the subsidiaries number. These numbers are simple. We are just presenting their balance sheet. So look at the balance sheet. These are book values because you are presenting 2 parties' financial statement in first 2 columns. Financial statement means balance sheet, income statement. That means everything is from the book value column. But look at that small part or the subs, income statement and statement of retained earning is blank. Why? Because subsidiary already closed their income statement items. They closed their revenues and expenses. Whatever the net income, that is actually adjusted with their ending retained earnings. So that means if you take their ending retained earnings here, I'm pointing my cursor here, subsidiaries ending retained earnings, it actually reflects their net income. It actually reflects their beginning retained earning. Net income captures all expense revenues. So one number captures everything and they closed everything. If you learn the closing journal entries, you know at the end of the year, just think of a regular accounting. We close all revenues and expense. We just take net income and we close it at income summary and retained earnings. So that means ultimately at the end of the year, you close all income statement items, and the balances you take from one year to another year are only from your balance sheet items. So that's what they did. They closed everything. So you don't need to worry about their income statement and statement of retained earning parts. It's closed. It's only their balance sheet. And balance sheet means the book value. So you just need to plug in these numbers I'm showing you from the book value column. So now what you did a step 1 and 2. You plugged in parents' information in one column. Then you plugged in subsidiaries information in second column. Now, what we will do? Remember, we originally started it showing as an investment. Now, my next goal is to eliminate the investment, make the investment 0, and rather take all their assets and liabilities and add balance sheet to balance sheet. And when we're gonna do this adding balance sheet to balance sheet, their assets and liabilities should reflect the fair value, no more the book values. So now what we're gonna do, we will do some consolidation entries. Everyone, please, here is one new set of journal entries. Please pay your attention. Now we're gonna do some consolidation journal entry. And for these consolidation journal entries, there is some what you call some acronyms. It's called SAIDE. SAIDE. These are the journal entries. Today we're gonna learn only S entry and A entry. So now, when we will do step 3 and 4, that means we have to remove subsidiaries equity. We will do S entry. And then when we will do step number 5, we will do A entry. It may sound a little bit of clumsy, but when you will see the numbers or we're gonna do by hand, you will feel much better. So I said that now we have to remove subsidiaries, stockholders' equity. Why? Because our goal is to add balance sheet plus balance sheet. But when you think of your subsidiaries balance sheet, don't consider both parts or both sides. Just take assets and liabilities. So remove their stockholders' equity, and at the same time eliminate that portion from the investment account. I'm repeating. Now I'm showing you S entry. It's denoted by S. S entry means remove subsidiaries stockholders equity. And when we're gonna remove it, at the same time we will remove the equal portion from our investment balance. Now, how we can remove subsidiaries stockholders equity? We will do a journal entry, and this is known as S entry. So now here, if I ask you, look at the subsidiaries stockholders equity item. Are these debit item or credit item? I'm showing my pointer here. Subsidiaries stockholders equity. Are these debit balance or credit balance? I know you are bored. Come on guys, use the chat box. My question is, subsidiaries stockholders equity. So what do you mean by stockholders equity? Stockholders equity means common stock, additional paid-in capital, and retained earnings. My question is, are these debit balance or credit balance? Please use the chat box. Stockholders equity, are these debit balance or credit balance? These are credit balance, right? We always know. Yes, Fiona, great. Thank you, Melissa. We always know assets are debit balance and stockholders equity and liabilities are credit balance. Now I'm asking you to close this stockholders equity. Close means you have to do the opposite. So you debit stockholders equity and if you debit all these, common stock, additional paid in capital, retained earnings, the total, if you add 100,000, 20,000, 480,000, it's equal to 600,000. And now what we're gonna do, we will eliminate the equal portion from our investment balance. So we have to credit 600,000 from the investment balance. And these two columns are consolidated entry column. So now I will just stop sharing, and then sometimes it's really bored if I just keep talking and talking and you don't kind of get chance to see what I'm doing now. So what I will do here, I'll just show you something here and you can see it, right? So now what we did so far, we are trying to add balance sheet to balance sheet. We are going to do consolidated financial statement, which means balance sheet to balance sheet. But remember, we originally started with the investment balance, investment in sub. But we cannot do both. We cannot show investment and at the same time we cannot show their assets and liabilities. So my goal is to eliminate investment and then just add balance sheet to balance sheet. And for this, we just mean that subs, assets and liabilities, and those will reflect their fair value. Now I'm talking about some consolidation entries. So what do you mean by consolidation entries? You will learn some consolidation journal entries. And this we'll learn only 2 journal entries, and chapter 3 we'll learn few more journal entries. So there is something you can write it down, SAIDE. So today I'm learning, we are learning only S entry and A entry. So S entry means remove subs stockholders equity. Stockholders equity. So remove subs stockholders equity. So now if you want to remove it, the example, we will finish it before we take a break. So basically how it looks like, you already saw that example. So if I want to write it, so we have to debit their stockholders equity. So we will debit their common stock. Remember, this is subs, or you can write it down in small ports, common stock, because it's a credit item. I'm removing it, I'm closing it, so I'll do the opposite. So I'll debit common stock 100,000. Then I will debit additional paid in capital 20,000. Then I will debit their retained earnings, which is 480,000. And now if you take the total, you will find it that this total is 600,000, and this portion I will reduce from my investment. So you have to credit investment in a small port or sub, investment in sub or a small port. So this is how the journal entry will look like. So now I just showed you that how the journal entry will look like if I want to write it here. So now here, let's go back to our slides, and you need to learn the journal entries. So I'm showing you on the slides, but you also need to learn by hand. So that's why it's good to show you back to back. And of course, we will do in Excel, which is a little tricky, but if you know the formula, especially plus, minus, then you should be fine. So we did the S entry. Right. Now we will do our next entry, which is known as A entry. So A entry means that we have to adjust subsidiaries' assets to reflect their fair value. Remember, when you plugged in the subsidiaries' assets for the first time, you plugged in, you did it from their book because this is their balance sheet numbers. These are book values. But I told you in the morning, and Sheila was confused, but I told you that when we'll do consolidation, it should reflect their fair value. So now what we're gonna do? We will do step number 5. We will do our SA entry, our second consolidation entry that will help to adjust or to convert their book value to their fair value. So now how it will look like. Please pay your attention. It's very tiny. It's hard to read, but you have your book or your slides that you can maximize or zoom in. Look at that. Pick one asset. For example, small port. Look at small ports, computers, and equipment. Their book value is 400,000, but their fair value is 600,000, isn't it? This is a small port or the subsidiaries. I'm showing you book versus fair. But when you plug in the number, you plugged in as per the book value. As per the book value. So all those numbers are book. But our goal is to show the fair value. So we need to do our second consolidation entry to convert their book value to fair value. That means we all see most of the cases book values are understated. Well, we will sometimes see book value could be overstated, but now just assume all book values are usually understated. So to reflect the fair value, we have to increase it. Please, everyone, try to read it with me. Computer and equipment. Book is 400,000. Fair is 600,000. I want to show fair because at the end, when we will add balance sheet to balance sheet, their asset liabilities should be at fair value. So, how much I have to increase? Their computers and equipment. We have to increase their computer and equipment by 200,000. Now this is an asset. We have to increase it. So what we're gonna do? We will debit it. So we debited computers and equipment by 200,000. And at the end, it will reflect both together the fair value. Now let's take the next one. Capitalized software. Please, everyone, capitalized software. Look at that. Small ports. Capitalized software book. It was only 100,000, but their fair value is 1.2 million. So we have to increase their capitalized software by how much? 1.1 million if I want to reflect their fair value. So that means I will increase their capitalized software by 1.1 million. So I debited capitalized software by 1.1 million. The same thing I'm gonna do. They didn't have any customer contract originally on their book, but we should consider customer contract and we know the fair, so we have to record it, debit it. Now, so far all these are assets. How about the liabilities? So liabilities, their book value is 200,000, but again, asset, liabilities, everything should be as per the fair value. So their book value of the notes payable is 200,000 and the fair value of the notes payable is 250. So we have to increase their notes payable because it should reflect the fair. We have to increase it. By how much? We have to increase notes payable by 50,000. So if I ask you to increase notes payable, should you debit it or credit it? Think it carefully. Notes payable is a credit item. It's a liability, it's a credit balance. So if you need to increase anything, do it what it is. So if I want to increase notes payable, since notes payable originally is a credit balance, I want to increase a credit thing, so I will credit it again. Remember, if you need to increase anything, do what it is. If you need to decrease anything, do the opposite. So now you know how to increase notes payable. You know how to increase all the assets. Now what we're gonna do? Remember, we started with the investment. Now we will eliminate investment completely. Still, you will see the journal entry is not balanced. Let's see what happened here. So, our original investment was 2.62. When we did the S entry, remove stockholders, subsidiaries, stockholders equity, we eliminated the investment, or we credited investment 600,000. We still have this investment balance, 2,020,000. Now this time we will eliminate the entire investment. So we will credit the entire investment. Now if you want to see the journal entry, you will see that your debit side is off. It's not a balance entry because your credit side you have 2,020,000 and 50,000. And if you add all the debit items that you increase, 200,000, 1.1 million, 700,000, your debit side will be off by 70,000. And this is what we call goodwill. And we have to debit goodwill. So we will show you this second journal entry. And of course, we'll take a break, but thanks for your patience. Let's write the second journal entry by hand and see how it looks like. So here I'm sharing this one again. So far what we did? So far we did S entry. Now we're gonna do A entry. Next class we'll learn other 3 entries. So A entry means what? This naming is a little bit weird. I think for S means they mean stockholders equity. A means adjust subsidiaries, subs, assets to fair value. So originally we plugged in the number in the second column, all were book value, but now we will adjust their assets to reach in the fair value. Now remember, I guess the A means this A. So now how the entry will look like. So now let me write it here. The A entry, this is my S entry. This is A entry, S entry. So you know how it looks like in your worksheet. You will practice here on the Excel sheet. Now you also need to know by hand. So A entry, what we did, we adjusted all of their assets and liabilities so that it reflects their fair value. So that means we increase those assets, we increase the liability, and then we eliminate the rest of our investment. And even after doing that, you will see that debit side is off, and that's what we're gonna plug in as a goodwill. So what did we do? I think if you have the problem with you, you can check it out. Their current assets, both book and fair are same. So we are not doing anything. If you look at the slides, please look at the slides. Small ports, current assets, both are, I guess, 300,000, 300,000. We don't need to increase current assets, but we increase computers and equipment. So let me write it down. Computer and equipment, we increased it. Increased means we have to debit the asset by how much? Book was 400, fair is 600. So we increase it by 200. So we debited it. Capitalized software. Capitalized software, their book was only 100 here, but their fair is 1.2 million. So we have to increase it by 1.1 million. Increase means we'll do the same. These are debit items, so we'll debit it. Then they didn't have any customer contract, but we have this fair value. We have to reflect it. So this customer contract from the original given table, you see its customer contract is how much? It's 700,000. We also need to increase our notes payable. And I told you notes payable is what? Notes payable is a credit item. So now if I ask you to increase notes payable, it's a credit thing. So I will credit it, do it what it is. So notes payable, their book, on their book, it's 200,000, but the fair value is 250. So I have to increase notes payable by 50,000. Now, Our goal is to eliminate the investment balance. And originally the investment was 2.62 million. From our S&T, we eliminated it 600,000. I still have investment balance 2,020,000. So now I'm going to eliminate it. Investment in sub or small port. So I will eliminate the whole investment thing because my goal is to show their assets and liabilities. I should not show both. Now, is this journal entry complete? Look at the numbers. If you add these things, 2.70,000, and if you add these things here, I think here you have 2 million. So here, this is $70,000 off. And what we call it, because you know originally when you showed the investment amount, which is 2.62,000, it's actually way higher their fair value. So we adjusted that portion. We reduced it as per their book. We adjusted all these assets, liabilities, and the differences, excess part, we did it. Still, we are paying 70,000 extra, and I call it goodwill. So this is how the A entry will look like. So that means if I ask you to do by hand, I think you should be fine to do both entries. I hope everyone is here. Just before taking a quick break, I will show you the last slides. And I'm going back and forth. Everyone will tell me if you have any issue or to see anything or hear me. So now what we did, we just did our second consolidation entry, which is A entry. And now the fun part, which means combined all accounts. Remember, when we're gonna do expense and revenues, we will do vertical. Vertical means revenues minus expense, and then balance sheet things we can add across the columns. But now you have to be careful here. And when we're gonna do the Excel, you will see the trick. Remember, when we add all these things across the column, this is my consolidated column, the final column we learned today. So this is what we are adding to these financial statements. And look at that. These financial statements are now reflecting both the parent and subsidiary. But when we added the financial statement for sub, basically we took their assets and liabilities part. And I discussed why. Because sub already closed their income statement items. So whatever they had, net income or whatever the retained earning balance, everything is reflected here, stockholders' equity part. So we don't need to worry about the part. It's just balance sheet to balance sheet. And that's what we did. Now, if you look at the consolidated numbers, here it reflects both parent plus subs numbers. But if I ask you, subs what numbers, book or fair, it reflects subs fair values. Now look at that, capitalized software. Total consolidated or combined amount is 1.7 million. It reflects both parent's number plus sub's number. And for sub, it's actually fair value because these two together is fair value. So now if I ask you to summarize what we learned so far, that means originally we started with an investment balance. Then my goal is to add balance sheet to balance sheet. So adding balance sheet means only we'll consider assets and liabilities for subs. And when we will add balance sheet to balance sheet, that means for subs, asset and liability items, we'll consider their fair value. So these combined numbers reflect parents' numbers plus subs numbers. And subs, what number? Subs fair value. So this part will be fun. You will see my Excel video. It's chart you have to drag or do addition or sum function across these columns. Now look at that. income statement. Whose number is this? Please, last minute before you take a break, income statement. Look at the income statement item or net income number. It reflects whose number? It reflects parent's number. How about statement of retained earning? Or if I ask you, ending retained earning, it reflects whose number? It reflects only parent's number. Now, how about assets and liabilities? Assets reflects both parent plus sub and sub's fair value. Liabilities reflect both parent plus sub's fair value. How about stockholders' equity? It reflects whose numbers? It's only the parent's number. So when you do this big worksheet by hand or on Excel sheet, by the way, I may not ask you to do the whole thing by hand, but the Excel will be your some additional practice I'll post on Blackboard. But for your exam, you might have a small like drop down menu or small calculations, but it is important to know these worksheets. So now what I'm gonna do, thank you very much for your patience. We should take a quick break, but my last thing, just a summary before we take a break. So far we did this consolidated financial statement, and if I ask you, and everyone please write it down, it's a cheat column. I tell it it's a cheat column, and now this cheat column will help you to do the exercise problems that we're gonna do after the break. So, consolidated financial statement. So, this is a cheat column to do everything quickly. So, if I ask any income statement item or net income, whose number it will be? It will be the parent's number. If I ask you to calculate the consolidated retained earnings, whose number it would be? It would be the parent's number. If I ask you to calculate any consolidated, remember all these are consolidated things, consolidated balance sheet item. Well, for balance sheet, you have three types of items, right? You have assets, you have liabilities, you have stockholders' equity. So now, if I ask you to calculate any consolidated asset, it could be cash, it could be building, it could be computerized software. Whose number would it be? Everyone take your cheat note. It would be parent plus subs, but don't forget it. You have to consider subs fair value because it's a common mistake. Students sometimes take subs book value. So the consolidated asset means parent plus subs, but subs fair value. Same thing with liabilities. Consolidated liability item means parent plus subs, but subs fair value. How about stockholders' equity? Before we take a break, can anyone use the chat box and help me? I forgot. Stockholders' equity should reflect whose numbers? Parents, subs, both? Thank you very much, Jasmine, Fiona, Jaden, Elisa, Sheila, Melissa. Yes, it's only parents because you remember the first consolidation entry, we eliminated subs equity. So if you know this cheat column, then you should be good, right? So you don't need to memorize it blindly. You know the whole picture. So right after the break, we will practice some problems, mostly small, quick problems using this cheat column. Thank you very much for all of your patience. So what we're gonna do now, we will take a short break. Say 10 minutes break, and we will start at 9:35. Everyone do not leave. I will take a screenshot, or I can also do the attendance just to see your name who are here. So thank you very much for all of your understanding, and I know we couldn't do it on Echo 360 because I was scared of the snow, although it didn't start here, but I will record the session. I'm recording it and I will post it again in case you need to see it. So you can take a break, please. If you leave, Make sure you come back at 9:35. Okay, thank you very much. Okay, I think we will start soon. I hope everyone is here, and I can see all the students are here, which is great. And I hope you all are back. If you already took a short break, now what we're gonna do, we will practice some problems. So here, you know, for your exam, you might have some conceptual multiple choice, true, false, or of course you will have some connect examples, exactly what you did on connect, and some will be kind of a blank box. You need to type in the box. I haven't prepared the exam yet. I hope I will make your exam by next week, and I will also show you the guideline, how you need to prepare yourself. So I would say up to this, just learn and practice what we did in class. And I have 5 students still didn't sign up on Connect. So please make sure you get your Connect access and practice 3 chapters examples. And I also have a sample exam. It's a long one, just all kind of together, all 3 chapters. So I hope you will practice everything before March 11. So March 11 is our exam 1. So please make sure, still 5 students, they are not on Connect. Make sure you got it. I know some of you ordered the book or the Connect card from Amazon, and it may take time to receive, but make sure as soon as you get your Connect card, you practice everything on Connect. And then we will also have some small examples you need to type in or write in. That's basically like the concepts that we are doing in class. So everything we will do in class. There will be nothing that you are not aware of, but sometimes, you know, I might have some very conceptual questions, and that will kind of figure it out, who will get A or 100 out of 100. So what I'll do, I'll practice some problems, but I'll just share something here with you. Let me show you the Blackboard, and then just a reminder for your group project, because again, several students are not in any group, and if you don't find any group, no worry, I'll just assign you randomly, or if you have any preference, you can tell me. So here you will see I prepared a link. I showed it to you last class. Many of you already did, many of you didn't. So if you go here, research project. So if you open this research project box or folder, you will see here research group list. So if you are not in any group, can you see it, or do I need to change the window? Can you see the research group page? Yes, no, chat box. Okay, great, Brian. Yes. So you see here, I have, yes, very good. So write down your name. I have 17 or 19 student, I guess. Some students signed up late. So every group will have 4 members. So here 5 groups will be excellent. And again, if you don't find any group, it's totally fine. I can see any group that needs member. So please, by the end of the day, make sure we write down your name in any of the group, because I will assign some topics. In pre-COVID era, we used to do some discussion and make a lottery in class and write down our topic name. But now I'll just randomly assign a topic. And then within that topic, you will figure out your own research question. And I will, next class, definitely, I'll save like 10-15 minutes to discuss about the research paper guideline. So please make sure you are in a group And if you don't find any group, that's totally fine. But it's good to have like a balanced group. Sometimes I see like some students, those are very active, smart, they all are in one group, and some groups don't get like, so it's good to have a balance. And then sometimes you might be annoyed and you will send me emails. Every semester I receive tons of emails that this group member is not doing anything, not responding email, not showing up during the meeting. But you know, this research project has a small weight, 10%, but it's not only like how to dig deeper in an accounting area, but also mostly like how to work in a group, right? So someone could take a lead to arrange a meeting or exchange views, make a chat or text message group, and then fix some Zoom or something, FaceTime, whatever. It's also a part of your learning how to work in a group. I know a few of you already mentioned you will be online, and I received your emails and registers email, and some students just declared. I know here, Brian, Kelly, and Elisa, you say that you will be online. It's totally fine. So you don't need to worry at all if you are online. You see, no matter wherever you are in class online, I promise I'll do my best to give you the best experience. Learning experience will be same in class or online, WebEx, Zoom, Echo 360. So don't worry if you are online or if you need to do any class online. So next class, definitely I'll show you the research project line. So now here, make sure you you are in a group, and please get the Connect access. And if you want to see the syllabus, I'm opening it. I hope you can see it. Sometimes I need to stop sharing and change the application. So can anyone see the syllabus that I'm showing? Yes, please. Jeff, thanks. I really love like if you respond chat box or if you turn on your microphone. So last week we are supposed to form our group, but I'm giving you one more week because we need to make sure we have the group finalized. If not, end of the day tonight or tomorrow morning, if I see someone is not in any group, I'll just assign you in random group. Now then, next class, today we'll finish chapter 2. Next class we'll do chapter 3, and I'll save 10 minutes for group project outline. And then we will have another class March 4th. We'll try to practice some exam type problems. Although everything we are doing in class, if we need to practice something extra, we'll do that. But again, Connect will be your format. You are getting the concept here in class, you are doing by hand, but practice it on Connect. And exam 1 will be on March 11. Make sure before that you practice all these assignments by hand and of course on Connect, because you will see Connect, they have some worksheet problem. You need to select drop down menu, you need to select the journal entries. So Connect is very convenient. And if you take CP exam, or if you I know some of you already started practicing, or I can give you access the Baker CPA course, you will see the setup is just like Connect. And for your CPA, sometimes you might have simulation problem. It's not only multiple choice question. So you will see those are kind of same thing, like drop down menu, and you have to drag and pick the correct answer. And again, you will have some questions you need to type in. So we will try to make a balanced exam. Some no calculations, some like very basic journal entries, some are exactly what you do in Connect. So everything is on Connect and with the different numbers, right? So that's an excellent opportunity to practice what we are doing in class. Do it on Connect with a different number. I see only 2 students did finish chapter 1, which is great. We are today finishing chapter 2. So everyone, I would say chapter 1 and 2, you should practice everything on Connect by this week. That should be the ideal thing. Not wait, please do not wait before like March 10th or the night before the exam. Trust me, if you are taking audit or tax course, you will see your midterms are on the same week, because this is how we split the syllabus. And then you will feel totally overwhelmed. I have tax exam tomorrow morning, I have this audit exam tonight. So it will be really difficult if you don't stay on schedule. So now, but I know you all are working hard and doing your best. So now here, what you need to do, please, if you have your textbook, please open chapter 2's assignment problem. If you don't have your textbook, go here, and please open chapter 2 assignment. I used to give you like print copy in class, but I couldn't, I'm sorry, but everything is here. Of course, I'll show you here, but sometimes the fonts are tiny, you may not see it well. So you can see the blackboard, right? So I'm requesting everyone, please open this, go to content, then click on the assignment folder and please open chapter 2 assignments. So I already scanned the pages here. So now what we're gonna do, we will about like 5 or 6 or maybe like about 10 examples we're gonna do. These are very short examples and kind of applying the topics that we learned today. So now first we will do this one. I believe you can see it. I will still suggest you to open your own problem either on your textbook or if you have digital textbook or at least from the blackboard, because you know sometimes if I project it, you may not see the numbers really well. So here we just saw the big net and small ports example, right? And this is kind of the same type of example that we're gonna do. So here you will see the example from your textbook chapter 2. Please try to read the problem first, then we'll solve it. So here True Data is your parent company and True Data is purchasing Webstat. Webstat is the subsidiary company. So you have True Data's financial statement or these items, book values, of course, these are from their book, balance sheet items, Webstat's book value, and you are also given the fair values. And we all know for the worksheet, final column should reflect sub's fair value. So that's what you have to remember. And then you have this information, True Data. They issued 10,000 shares for purchasing Webstate. Now look at that. This common stock PAR, par value is $5. And True Data's stocks are traded at $40. So what's the purchase price? Can anyone do it very quickly? True Data issued 10,000 shares to buy Webstate. It's just the share. No cash, no contingent liability. Excellent. Jeff, Alisa, everyone, please come up. Come here. Everyone, not only 3-4 people. Where is Brett? I didn't see some students responding at all. So Mike, thank you. Everyone calculate the purchase price. It's just the share. Thanks, AJ. Just the share. Very simple. No cash. Even I would say big net was complicated. Thank you, Brett. So 10,000 shares multiplied by $40. This is the purchase price. You all know well. Now here you have this tiny teeny little problem. We will now do 15 to how many? 15, 16, 17, 18. So let's do these 4 problems. And some are really quick. You should know the cheat column that we discussed. Some we may need a little bit of concepts. And some we will recap everything. And get ready with your calculator. And use the chat box or I will call by name. So now I will write here using my mini doc cam and you will solve the problem. Please do it by hand. If you want to do it using your computer, that's excellent. So I would request, please, I'm showing you the problem, but it's a little bit tiny. So I'd request have your own problem in front of you, read it and help me to do it. So now here, first question, here, let's read it. On its acquisition date, balance sheet, what amount should True Data report as goodwill? So we learned the term goodwill many times, right? And I showed you different ways to calculate goodwill. Now, before starting the problem, let's recap it. What you did in chapter 1. You know, chapter 1, we practiced a couple of problems and we showed like how the investment balance changes because of investees' income, dividend, excess amortization, and we follow the format. It's the same thing. You could follow the same format here to calculate goodwill. But there is another shortcut I'll show you. So if you recall the format we learned last class, is the same thing. Instead of certain percentage, now we'll assume acquisition is 100%. Things are even easier. So what we learned in chapter 1, we did some problem following these format. So I'm writing it. I will appreciate if you write with me how to calculate goodwill. So one format we saw last class is that we start with purchase price. Purchase price, you don't need to worry about percentage because everything is now 100%. So you start with purchase price. Then we subtract the net book value of the subsidiary company or the company we are acquiring. We subtract that net book value. I'm talking what we did last chapter. Then we call it, this is the excess cost, right? You remember this is the excess cost. So the difference, what we paid on top of their book, this is the cost in excess of their book value. Then we try to justify, why did we pay this excess amount on top of their book? And we all agree that book is always understated. Book does not reflect the real value. So we try to figure out what are the understated assets, or if there is any asset not on their book, but we should know the fair value and should include it. That means we try to justify why we pay this excess cost on top of their book, and we try to allocate this excess cost among undervalued assets. So allocation to understated or undervalued assets, right? So then we try to justify whether they do have a building, or they have patented technology, or they might have some equipment. Those are undervalued. So we try to justify why we paid this excess, and we allocate that excess amount. That means the difference of those assets, fair versus book, if those are undervalued. And then if we see we are still paying something extra, we call it goodwill. So this is what we did last chapter. Although we saw in chapter 1, we ended up with 0 goodwill. That's fine. I intentionally followed the format because this will be useful in chapter 2 and 3. Now, I will show you another way to calculate goodwill. It's very quick and easier. Now you could tell me, why didn't you tell about this easy format before? Because not every problem will give you every information. So depending on what type of information you see on the problem, you have to use the format to calculate goodwill. So this is one way to calculate goodwill. Another way to calculate goodwill is very simple. It's goodwill means purchase price minus net fair value of the sub. That's it. Some problem will give you all the fair values of assets and liabilities, and you can calculate goodwill in 30 seconds, I promise. So this is the easier way to calculate goodwill. So instead of starting with net book value and understated, overstated portions, if you know all of their fair values, some problems will give you, you can easily calculate goodwill. So basically, what is fair value? Fair value means your book value plus those difference, right? This two is basically fair value. Now, depending on your information and how you practice and how you could trace out the information, you can calculate goodwill. So now, if you look at this problem, they are so nice. They gave you all assets and liabilities fair value. So you can easily calculate goodwill from here. So I hope you can see it. If not, we will use this short, easy formula to calculate goodwill. And you already did the purchase price. Many of you typed in the chat box. Those who didn't, you can still take a look at the chat box and calculate the purchase price. So if I ask you to do question number 15, can we do it? Question number 15. Let's do problem 15. And it says, what is the goodwill that true data should report? Very easy. Trust me, it's very easy. That what it sounded earlier. So we're gonna use this quick way. So goodwill means what? Goodwill means purchase price minus net fair value of sub. Right, net fair value of sub. And we already did the purchase price. If you didn't do it now. What is the purchase price? Many of you helped me. Purchase price is what you pay. This time, True Data is giving only shares. How many shares? 10,000 shares. And when we calculate it, do not take PAR, par value. Par value is just for common stock recording purposes, just the value stated. But we will consider their current share price, which is $40. So we already did it, and you all agree that the purchase price is 400,000. Now, can anyone help me to calculate the fair value? This problem is very nice. And what they did, they give you this beautiful column. So can you please calculate the fair value from Web States fair value column? And what you need to do, remember, fair value means net fair value. That means you have to add all these assets, then subtract the liability. So please, everyone, would you please use your calculator and calculate the net fair value of Web State from this column I'm showing you. Let's see, I'm waiting for the chat box, and I'm sure you all are doing it. Otherwise, I'll just take and call someone's name. Okay, very good, excellent. 5, 6 people. Jaden, thank you. 7, 8 people. I want to see more people. Chris, thanks so much. Beatrix, excellent. Excellent. Everyone, use these fair value numbers. I don't know if you have like the print copy, but look at your scanned copy that I posted on Blackboard. So it's always good. I always feel handy to have like all papers, pencils. So if you cannot see it well, you can see it on Blackboard. So excellent, everyone. You say 385,000. So if you just take this fair value, remember net fair value means asset minus liabilities. So we always subtract liabilities to know it. So now who can tell me goodwill quickly? I want to know, everyone can calculate goodwill. What's the goodwill? Thank you, Alisa. 2, 3, 4 people, 5, 6, 7 people, 8, 9, 10. Everyone, thank you, Fiona. Alec, good job, AJ. AJ. So, don't copy from the chat box. Calculate it. Learn it, everything in class. This is why you are here. You woke up early, right, in this rainy, snowy day. So, goodwill is 15,000. So, now you know the easy way to calculate goodwill. Excellent. Thank you. So, now let's do next problem and make this information in front of you. I may go back and forth. So here, the next problem is talking about on the acquisition date, on their consolidated balance sheet, what amount should True Data reported as patented technology? So now I'm asking you to calculate one consolidated item. And before we took the break, we already have this note, and you took it, right? This cheat column. Now they are asking to calculate the patented technology, which is an asset. Jeff, excellent, which is an asset. And you already know one consolidated asset means what? Parent plus subs, fair value. Don't be confused with two columns because they gave you both column, book and fair. Excellent, Jeff. It's not only Jeff, everyone, please calculate. They are consolidated patented technology. You know the cheat column. You have this cheat column information. So now, let me move it a little bit. I'm gonna do number 16. Consolidated patented technology. It's an asset. Patented technology. And we just learned it. It means what? It means parent plus subs. So you have to look parents patented technology and subs patented technology, but sub does have like two columns. Don't confuse two columns. We will take subs fair value. So can anyone write down the number? I know Jeff already mentioned it. Let me see what I find. So parents patented technology is 230,000 plus subs patented technology. Alisa, good job. Is I will look at the fair value column. I'm repeating it. Many students take the book value. I don't know, I tell it in class every time. Take the fair value, but many students during the exam take the book value. So I'm just kind of giving you some heads up. So it's 200,000. So my consolidated patented technology is, thanks Matt, and everyone write it down and do it, 430. You can do multitasking. You are very smart. You can go back and forth different browsers and like different document and do it. Use the chat box. You are very good at it. Thank you. So we did patented technology. Now the next one. Look at the problem. It says, on its acquisition date, what is true data's common stock? So can anyone tell me, if I ask you consolidated common stock, whose number it should reflect? Parent, sub, both? I'm asking you common stock. Remember, what is a common stock? Which part of your balance sheet you should look at? Yes, common stock is a part of your stockholders' equity. So common stock means only parents. So now let's look at parents' number. Melissa, you are right. It's only parent. Common stock is a part of your stockholders' equity. It's only parents. Now, remember when we looked at the big net and small ports example, you saw like they already had some common stock before acquisition. Then on the day of the acquisition, they issued new common stock. That means it's only parents, but it should reflect both. It should reflect both. So that means look at the parent column. I'm sorry, my doccam is not that up to quality. I can zoom in, out, or adjust that much. So if it's not clear, you can look it from your own book. So here, look at the column here. So parents' common stock, you can look at parents' common stock, but remember, this table gives you the common stock right before acquisition. And on the day of the acquisition, they issued new stocks. So we have to consider both. The parents' common stock before acquisition plus they issued new stock. So can anyone help me? What would be the common stock? And we all agree it should be only parents. So let's see. Take your calculator and do it, and I'll copy you. So my question is, what is your consolidated common stock? So it's question number 17. So consolidated common stock, and we all agree it's only parents. I'm writing P. P means parents, but remember they have their original common stock. Plus they issued new common stock. So you have to consider both. Did anyone use the chat box? Elisa found 350. Can anyone break out the number? Great, great. Jeff already broke the number. Sorry, I missed. If I missed anyone's chat, yes, thank you, Jeff, for breaking out the numbers. And other people, please calculate it here. So now let me check. Just give me a minute. Sometimes I cannot see the chat. I'll just make sure the chat pops up here. Okay, great. Yes, thank you very much. Thank you. Now let's do it. All of you did it, which is great. So consolidated common stock means what they have originally before acquisition. On the day of the acquisition, True Data issued new shares, 10,000. And remember, when we consider the common stock part, it's their PAR par value. This PAR par value. This is PAR par value. So we will consider this $5, which is the PAR par value. You already saw the journal entries. So that means before acquisition, 300,000 plus the 50,000. So the consolidated common stock will be only parents' common stock, and it's the both before acquisition and on the day of the acquisition. Very good. Now, one question I will ask, and I would expect all 19 students will do it. It's not in the problem, not in this assignment problem. Can anyone calculate the consolidated additional paid-in capital? Consolidated additional paid-in capital. Whose number will it be? Parent, sub, both? Additional paid-in capital, whose number it should reflect? Anyone can use the chat box. I'm sorry why I cannot see the chat now. Yes, someone please give me some hint. Is it parents or subs or both parties? Consolidated additional paid-in capital. Again, additional paid-in capital is your stockholders' equity. No, Jade and Melissa, it's not both. Don't copy them. Matt, you are right. It's parents, Sheila. So you know what? If you look at the cheat column, Jaden, come here. If you look at the cheat column, you see here, I just showed you stockholders' equity. It will be parents. But what do you mean by stockholders' equity? Stockholders' equity means common stock, additional paid-in capital, and retained earnings. So just like the common stock, additional paid-in capital is also parents. So now my question is, what would be the consolidated additional paid-in capital? It's only parents. But just like what you did a minute before, common stock means whatever the common stock they have before acquisition plus the new common stock they had on the day of the acquisition. Now for additional paid-in capital, can you calculate it? What should be the consolidated additional paid-in capital? It's the same, what they have originally plus the new part from their issuance, new issuance. Where is Jeff? Where is the other people? Calculate. Alisa, thank you very much, Alisa. Other people, great. I really appreciate Alisa did everything. Type it in. So again, we're gonna follow the same thing. Whatever they had additional paid-in capital before acquisition. Of course, I'm looking at the parent column. If you are lost and cannot get Alisa, parent column. So before acquisition, they have 10,000. So this is my before acquisition plus they issued new shares. How many shares they issued? 10,000 shares. Now, what is each share's additional paid-in capital? You know, True Data's current shares are now traded at $40, right? This is dollar sign, $40. And then their PAR par value is $5. So this is their each share's additional paid-in capital. Each share's additional paid-in capital is $35 for the new stocks You multiply it by 10. That means it's the new additional paid-in capital 350 plus they already have original additional paid-in capital that they had before acquisition. And all together, the parents' updated additional paid-in capital is 360. And we all know consolidated additional paid-in capital means parents' additional paid-in capital. So this problem is not in this book, in this paper, but I still just showed you and you can do it. Thank you very much, Alyssa. Now, let's do this one. Next question is talking about number 18. On its acquisition date consolidated balance sheet, what amount should True Data report as retained earnings? Okay, first tell me, retained earnings, whose number it would be? Is it parent, sub, or both? Parent, Fiona, excellent, AJ. So my next question is number 18, and it's asking consolidated retained earnings. Consolidated retained earnings, and you all are correct. It should be parents. Yes, Chris, Matt, you are correct. So now we will just look at parents' numbers. Retained earnings. Look at the date. It says retained earnings as of July 1st. And now let's go back to the table. Go back to the table. You see something here, retained earning, but it's January 1st. So the acquisition happened on July 1st. I'm asking you to do consolidated retained earning. You all agreed it's only parents, but we have to figure out their July 1st retained earning. The table didn't give you July 1st retained earnings. They gave you January 1st retained earnings. But wait a second, they gave you revenues and expense for these 6 months. And you all know how to calculate ending retained earnings. I know last class, who was that? Fiona or Sephora kind of told me what I should write down in a statement of retained earnings. And we can do it. Sephora, are you here? I don't see you in chat box, or someone please help me to calculate the ending retained earnings. So we just know beginning retained earning 130, but we don't know ending. But we know for these 6 months revenues and expense. And another thing you should look for it here is the dividend. But is there any dividend? I don't see any dividend here. No worry, let's follow a chart. What we actually do for retained earnings. So basically when you prepare the statement of retained earnings, we start with beginning retained earnings. In this case, it's given beginning retained earnings is January 1st. It's given from here, this table, you can look at it. It's given here 130. So beginning retained earning, Jeff, excellent. Beginning retained earning is 130. But I don't know the ending retained earning. Not a big deal. We know how we can calculate it. Beginning retained earning, then we add net income, then we subtract dividend, don't we? So we subtract dividend. This is how you calculate ending retained earnings. So my ending means it's July 1st. So now let's plug in the numbers. Net income, everything is only parents. Look at only parent. Net income, we don't know their net income, but you know revenues and expense. Look at that here. And thanks, Jeff, again. So you know revenues and expense, so you can calculate net income. Net income is nothing. It's revenue minus expense. So it's revenue minus expense, right? So that means, look at the number. Their revenue is 250. And then I'm looking only at true data. Remember, it's parents only. Expense is 170. So if I take their revenues and expense, which give me 250 minus 170, it's 80,000. So for these 6 months, parents' net income is 80,000. Do we have any dividend number? No, we don't. So you can just keep it blank or put a 0. Now, here, this is their beginning retained earning. We add net income, we subtract dividend. We don't have any dividend, no worry. These two together will be your ending retained earning. It's 210. Excellent. So this is how you can calculate the retained earning at the end of the period. That means here, July 1st. It's only parents, and we already agreed that consolidated retained earnings means parents' retained earnings. Great. So now we did this problem. So you will have this type of problem. This problem is very nice setting. Everything is given here. And actually, I did an Excel practice. I'll post it on Blackboard. So if you see all this fair value information, it's really beautiful. You can calculate the goodwill in a minute. You know all those information. But sometimes some problem may not give you all this information. For example, now I will show you another problem and then we will solve it. Here, let's see. I have a couple more problems and I should have another page here. Let's do problem number 12 and 13. So again, this problem is not that nicely set up. So now let's read it from the slides. It's not very clear from this projector, but I believe you have this book or you can open it from your Blackboard. So let's read this problem I'm gonna do now. We all will do together 12 and 13. So I told you some problems, the information is not that nice, but we'll try to do it. So here on May 1st, Donovan Company reported the following account balances. Okay, so this is kind of their balance sheet, you can say. Donovan, remember, Donovan is a party, but we still don't know whether Donovan is the parent or sub. On May 1st, Beasley paid 400,000 in stock. They paid all stock. They actually calculated it for you, 400,000, and that's for their assets and liabilities. Right. So now here, they are not giving any cash. They are issuing stocks, and you already know the fair value. So this is the purchase price. But let's see if there is anything else. They said that during the acquisition, they have some legal and accounting fees, and they didn't pay it. It's accounts payable. Although you have to record these legal fees, investment bankers or acquisition fees as an expense, they didn't pay the cash. It's an accounts payable. Next paragraph told you some little more different information. Beasley also agreed to pay $75,000 to the former owners of Donovan. So here, if they meet certain revenue goals. So remember, they're gonna pay these $75,000 when? During the following year. Beasley is the parent, Donovan is the sub or the company which is acquired. So they said that we will pay you $75,000 if you could meet this certain revenue goal. But now today, how they will consider it? They did some present value with some probabilistic adjustment, and they calculated that the probability adjusted present value of that future payment is $20,000. So those who are finance major, you should know how to calculate the present value. And if you take any advanced stat class, you should know how we can calculate probabilistic present value. So you don't need to do anything. They actually gave it to you. So what they're going to pay in the following year, you already know the probability adjusted present value is 20,000. Remember, you have to consider this 20,000 as part of your purchase price. Although you are not paying it on spot, but this is a conditional payment and we call it contingent liability. Contingent liability could be part of your consideration on purchase price. You saw it when I showed you that big net examples on your slides. So that means if I ask you, what is the purchase price? The purchase price will be these 400,000. This is the fair value of all the stock plus the present value of these future payment, which is a contingent liability. So your purchase price will be this 400 plus this 20. So purchase price is 420. Right, everyone can see it well? Please make sure you have this problem because when I'll switch to DocCam, the numbers will not be that much big or visible. Now, how about this? This is your legal and accounting fees. You have to expense it and show it as an expense as a separate. It's not part of your purchase price. Now you have little more information. Donovan has a building. Fair value is 30,000 more than its book. That means if you look at Donovan's mini balance sheet here, building equipment together is 220, but of course this is balance sheet. This is from their book. This is book value, but if you consider building, it should be 30,000 higher than this. Then you have few more bullet points. Donovan developed unpatented technology, which is 25,000. It's not recorded in their book. But when we consider at the acquisition day, we will consider the fair values plus all these things that are not on the book. Now you have one more information. Donovan has a research and development activity that R&D is not on their book yet, but that has a fair value, 45,000. So that means this balance sheet or this problem didn't give you a nice, beautiful fair value column, but they put some bullet points here that will help you to calculate the difference of the fair value. And the last bullet point says, book values of Donovan's current assets and liabilities approximate fair values. That means for their current assets and liabilities, book and fair both are same. So now we will use those bullet points and their little balance sheet here, and then we'll solve the problems. So now here I will switch back to my DocCam, and if you can open this problem in front of you, that would be great because the DocCam may not be very clear. And then I may ask you questions and will help me to solve it. So now let's do this problem. So it's the same thing. We already discussed it. You saw it very clear. And I really apologize. The quality is not like classroom DocCam quality, but we will work it out. So my first question, if you read it, what should Beasley record as total liabilities incurred with these Donovan's merger? It's not like typical question that you did in your previous problem. It's not asking like consolidated liabilities, consolidated balance sheet, or something like this. It just says, what is the new liabilities incurred from this acquisition? And of course, we're gonna think of it from Beasley's perspective. Beasley is the parent. So here, of course, when Beasley will think of the liabilities, Beasley will take all of Donovan's liabilities, right? Because when you acquire someone or some business, you take all of their assets and liabilities, right? And of course, when you have to consider that liabilities, we will consider their fair value. And they have a bullet point. The last bullet point, you see, they say their liabilities book and fair same. So we have one piece of information. Another piece, this is not kind of the combined or consolidated liability thing. It's, yes, Jaden, I'm sorry if you are lost. I'm sorry if I didn't tell you, we are doing 12 and 13. So everyone please do 12 and 13. And I'm just talking and giving you some background information before we jump in the numbers. So I'm talking about the question that what would be the liabilities that Beasley should record from these Donovan's mergers. Of course, they will consider Donovan's liabilities, and you always know assets and liabilities should be considered as per the fair value. Second, liabilities they have to think of, or when they will show it as an investment, is that contingent liability part. And you have this information, right? In this previous page, previous paragraph, you have this little paragraph that is talking about the contingent liability. We are doing everything here on May 1st. We'll take the present value. Then you have another liabilities. Remember, you have some attorney fees or legal fees. These are expenses, acquisition expense, but you are not paying it now. You have to pay later. Right now, you show it as an accounts payable. Right, thank you very much, Alisa. Great job. I love to see the chat box now. I'm trying to help everyone explaining everything. Now, those who didn't get it yet, we'll do it together. So, problem number 12 is talking about what's the liabilities incurred from this acquisition. Of course, you have to consider the subsidiaries' liabilities. Right, and we will take the fair value of Donovan's liability. Donovan's liabilities, which is already given here. So they say their book and fair same. So Donovan's liability, it's here. If you see, it's 60,000. It's 60,000. Thank you very much, those who already did it. Then I told you that think of it from Beasley's perspective. Beasley is the parent. What Beasley also recorded it. They have this contingent liability, right? Because they're going to pay it later. So it's part of their purchase price. When they're going to record investment, they will record these contingent liabilities. Look at this paragraph. I'm showing it here. This paragraph, but take the present value. Take the present value of this contingent liability. So I'll write it down. Present value of contingent liabilities, which is 20,000. And then they have to pay this legal accounting fees. Definitely they will do the journal entries, legal and accounting fees, expense debit, and accounts payable credit. They didn't pay it yet. So that means it's accounts payable for legal and accounting fees, which is 15,000. So these three together, and I already see the numbers here. Thank you, Elisa and Jeff. It's 95,000. This is the total liabilities incurred because of this acquisition. Remember, it's not asking about consolidated liabilities. It's just asking from Beasley's perspective, what's the new liabilities they're going to record related to this acquisition. Total liabilities incurred to this acquisition. So, this is question number 12. I hope you got it. Thank you, Elisa and Jeff, or who did try. Next question. How much asset Beasley should record as total asset acquired in Donovan's merger? So, here, of course, he will get Donovan's assets. And remember, you have to record it as per the fair value. So we will consider all of these Donovan's assets and we'll figure out the fair values. Although we don't have that beautiful table, it's just their book value or balance sheet numbers plus some bullet points. But we will consider the bullet point and figure it out. What would be the fair values of Donovan's assets? Now, in addition to that, sometimes if you see that your purchase price is higher than the net fair value of subsidiaries' assets, you may need to calculate goodwill. So that means when the question is asking, what's the asset that Beasley should record? Of course, it's Donovan's assets or the fair values of Donovan's assets plus goodwill. So now we will do it. Okay, let's try to figure out the fair values of Donovan's assets. Unfortunately, they don't have any fair value column. They have all these bullet points, but you will help me to calculate the fair value of Donovan's assets. Then you will help me to calculate the goodwill, because goodwill also will be an asset that they're gonna record. So now let's do that part. Fair value of Donovan's assets. Fair value of Donovan's assets. So we will start with looking at their mini balance sheet that is already here. But those are book value. So we will look at the bullet points back and forth. And you will help me to calculate the fair value. Let's start with current assets. So the last bullet point says for current assets, their book and fair both are same. It's approximate the book value. So that means for current assets, I'm doing fair value. Current assets, fair value will be the same, just like their book here. Look at that here. So current assets will be, fair value will be the same, 90,000. Next asset, building and equipment. Building and equipment. Everyone, please keep your patience and attention. It's a little bit difficult. I mean, like the information is messy. Building and equipment, their book is 220. Because it's given this mini balance sheet, book is 220. But you have a bullet point number 1, it says that buildings fair value is 30,000 more than the book. I'm showing everything fair value. So I'm gonna add 30,000. So that means their building and equipment fair value will be 250. Very good. Now, if you look at this balance sheet, if you look at their balance sheet, I don't see any other assets. I'm calculating the fair values of Donovan's assets. If you see the mini balance sheet, they just have current asset, building and equipment, and we wrote their fair values. But look at the other bullet points. The other bullet points says they have unpatented technology, they have R&D, right? So now here, what we're gonna do, we will write down those values too. So although those are not on the book, but when you have to calculate this net fair value or the fair value of the assets, you have to consider those missing assets. So write down their unpatented technology, and the value is given here. Unpatented technology is 25,000, and then they have an R&D. So they have an R&D here, which is also given 45,000. So R&D is 45,000. So who is first with calculation? Can anyone add this for and tell me what is the fair value of Donovan's assets? Donovan's assets. Just add these 4 assets. You looked at the book and then you looked at the bullet points, and thank you, Mike, and someone else also did it. Their fair value of total asset, Brian, Jasmine, Tony, Anthony, great, 410. So of course, when it's asking the assets that Beasley gonna record, of course, we will record their Donovan's assets as per the fair value. And I told you that you also need to calculate goodwill. So now we got the fair value of Donovan's assets. Good, we are good here. Now can we calculate the goodwill very quickly? You already did it many times. And then what we're gonna do, we are almost there to calculate the net fair value, and you can figure out the purchase price. I actually discussed it at the beginning when I read the problem. Can we try to calculate the goodwill? So now, here, we already know that the easy way we learned today, goodwill means what? Goodwill means net fair value. I'm sorry. Goodwill means purchase price minus net fair value. Purchase price minus net fair value of sub. Now, can anyone help me to calculate the purchase price? What is the purchase price? Anyone try to do it, please. Purchase price. Purchase price means they issued stocks. You already know the value of the stocks, which is 400,000. And don't forget to include the contingent liabilities, because that contingent liability is a part of the purchase price. So when I ask you to calculate the purchase price, of course, the stocks they issued, which is given right below this. I cannot show everything here, but you should have the problem. So right below here, it says Beasley paid stocks, the fair value is 400,000. So purchase price means this 400,000, the fair value of all the stocks that Beasley gave to Donovan, plus the contingent liability. Please don't forget to include contingent liability, and this contingent liability, we're gonna take the present value. So we have to take the present value of these contingent liabilities. So my purchase price for this deal is 420,000. Is it clear? So this purchase price, this is contingent liability. I'm writing it if you get confused, because contingent liability is the part of your purchase price. And then for this contingent liability, take the present value. Students make another common mistake, because if you read this paragraph, they said 75,000, you will just rush in and pick 75,000. But make sure you take the present value. So my purchase price is 420. Now I need to get the net fair value. So we know the fair value of the assets. How we can know the net fair value? Remember, net means assets minus liability. So far you know Donovan's assets. So if you subtract Donovan's liabilities, of course, the fair value of Donovan's liability, they said that their book value and present value of the liability is the same. That means, look at this book. Look here. So their liabilities book value is 60,000, and last bullet point says for liability, book and fair both are same. So if I subtract liabilities from my assets, it will give me net. Net means asset minus liability. So the net fair value of these Donovan's assets minus liability is how much? 350,000. So now you know the purchase price, which is 420. You know the net fair value of sub or Donovan. Now who can calculate the goodwill and write it very quickly? Calculate the goodwill and write it in the chat box. Come on, you guys are quiet. We are almost done. Yes, thank you very much. You are very fast. I know. So now, if it's this, and yes, I'm copying, and you know, you did well. Your goodwill is 70,000. So now, what we did? We calculated goodwill. We calculated the net fair value because we needed to calculate goodwill. You know how to do purchase price, but we didn't do the actual question yet. So the actual question is, how much Beasley should record as the total assets? So now Beasley will record how much as the total assets. Let me show it here. So the total asset acquired from this acquisition is this. The fair value of these all Donovan's assets plus the goodwill. So now, if I ask you to do the actual question, it's the total asset recorded related to this acquisition. Total asset recorded is, of course, the fair value of Donovan's assets plus goodwill. That means not the net fair value. Look at their fair value of the asset, which is 410, and they have a goodwill. They will also record goodwill. It's an asset, 70. So the total asset incurred is 480. This is actually the correct answer for this problem. So, are you good? So you know what? I have just one more problem. I wanted to finish it. So just give me 2 more minutes. We still have time. Let's do problem number 14 very quickly. I promise we can finish it. So now we will do problem 14. Then you will be covered with most of the problems and you will be ready to do your connect. So problem 14 is talking about your consolidated additional paid-in capital and retained earning. Well, we did it a little. Still, let's read it. So here, 2 companies. Let's figure out who is the parent, who is the sub. Atkins is the parent. They issued 51,000 new shares, and their share, $1 is PAR par value. This is Atkins numbers. And the current trading price of the share is $3. And then Watterson is the sub. And this is their information: common stock, additional paid-in capital, and retained earning. So your question is, what are the consolidated additional paid-in capital and retained earnings? So you already know it. Consolidated additional paid-in capital means parents' additional paid-in capital. But we did it. It means parent means Atkins. Atkins' additional paid-in capital before acquisition, and on the day of the acquisition, what the new additional paid-in capital. You have to consider both. So please do it. So consolidated additional paid-in capital, we know it's parents, and who is the parent here? Atkins. But remember, this is their pre-acquisition additional paid-in capital. That means their original additional paid-in capital plus their new additional paid-in capital, right? That means the new stock they issued. So what is the original additional paid-in capital? So you have to look at this. Here, this table, it's already given. Additional paid-in capital. Atkins' original additional paid-in capital is 90,000 plus new additional paid-in capital. So how many shares they issued? They issued 51,000 shares, and their current share selling price is $3. And if you look at this table, PAR par value is $1. So can anyone calculate this part very quickly? So each share's additional paid-in capital is $2. 2 multiplied by 51 plus 90. What is their combined additional paid-in capital? Combined additional paid-in capital. Can anyone write it? I promise I'll finish it. I really apologize taking one more minute. Fiona, okay, thank you very much. 192. So this is their combined or consolidated additional paid-in capital. It is also asking consolidated retained earnings. Consolidated retained earning means, of course, parents' retained earning. And I know parent means Atkins. And this problem is not complicated. It's given here. Just look at Atkins numbers. And there is no complication like beginning or ending retained earnings. It's given here. Atkins retained earning, which is 300,000. So this was really short. So I took extra couple of minutes just to make sure you are ready to start your Connect for chapter 2. So what we did today, we finished chapter 2. That was our plan. Next class, we will finish chapter 3, but promise you will practice chapter 1 and 2 by hand and of course on Connect. And next class, I'll try to give you some outline for your exam ahead. This is a new exam I have to make from the scratch, but I'll make sure everything we do in class. And again, I took a screenshot, so I know already who are present. Don't worry about your attendance. And thank you very much, everyone. I recorded the session. I'll upload it. Thank you, Jaden. I'm happy to see you. So thank you, everyone. Take care. Stay well. Drive slowly. But I hope next 2 days you will be safe whenever, like on campus or home. Thank you and enjoy your snow day too. Thank you, Brett. Thank you, Mike. Hopefully next week will be good weather. We will be on Echo 360. Thank you. Bye-bye. Take care. So
thank you.
I'll see you now.
Thank you. Bye, Professor.
Bye, Jaden. I'll stop recording and I'll post it on Blackboard too. Okay.